Hello, what's up, traders? Hope all of you are doing well. Welcome back to our next video of Prime Contest trading class. In today's video, we will discuss another trading strategy that might be suited for you, and maybe it's also the common trading strategy. Yes, it's a range trading strategy. But first, let me introduce myself. I'm Donovan. I'm trading analyst of Prime Contest and I've been experienced in trading for 9 years. Alright, let's move to the main topic. Now, please read this disclaimer that all information is being presented for educational only purposes. And information in this video should not be considered as containing investment advice or investment recommendations. Understanding the range trading. Range trading is a popular trading strategy used in the forex market, as well as other financial markets, to take advantage of periods of price consolidation or sideways movement. In the forex market, currencies often experience periods of limited price movement where the price bounces between defined support and resistance levels. Range trading strategies aim to capitalize on these price ranges by buying at support level and selling at resistance levels. Identifying a range. Before employing a range trading strategy, it's crucial to identify a well-defined price range on the chart. A range is characterized by relatively horizontal price movements, while the price oscillates between clearly defined upper and lower boundaries. These boundaries are formed by support, lower boundary, and resistance upper boundary levels. Okay, before I give you a practical example of this, I want to tell you there are 3 types of range trading strategies: range trading with pivot points, range trading with volume indicators, and range trading with volatility indicators. Range trading strategies with pivot points in forex trading. Pivot points are commonly used technical indicators that assist traders in identifying potential levels of support and resistance within a given trading session. By combining range trading with pivot points, traders can effectively identify entry and exit points, manage risk, and make informed trading decisions. Pivot points. Pivot points are calculated based on the high, low, and closing prices of the previous trading session. The central pivot point or PP serves as reference point of potential support and resistance levels. Additional levels known as support S1, S2, S3, and resistance R1, R2, R3 levels are derived from the pivot point. These levels help traders anticipate potential price movements and make trading decisions. Practical explanation. Let's do it. Using range trading strategies with pivot points. First, identify the range. On the chart, locate periods where the price has shown a tendency to oscillate between specific support and resistance levels. Plot pivot points. Calculate the pivot points based on the previous session's high, low, and close price. Plot these levels on your chart. Confirming price reversals. To make informed trading decisions, use additional indicators like moving averages, RSI, MACD, or other oscillator to confirm potential price reversals within the identified range. Entry and exit points. Look for buying opportunities near the support levels and selling opportunities near the resistance levels. Combine pivot points with other technical tools to fine-tune your entry and exit point. Okay, now how about the pros and the cons of using range trading with pivot points? Let's talk about the pros first. Clear trading range. Pivot points provide objective level of support and resistance, offering a clear range for trading decisions. Objective decision making. The strategy relies on predefined levels, reducing emotional bias and subjective decision making. Risk management. Well-defined ranges allow traders to set target stop loss order, managing risk effectively. Short-term opportunities. Range trading strategies can be especially effective in sideways or consolidating markets, offering short-term profit opportunities. Now, let's talk about the cons. Whipsaws. In volatile markets, price can break out of the range unexpectedly, resulting in false signal and potential losses. Limited in trading markets. Range trading is less effective in strong trending markets where prices consistently move in one direction. Lack of fundamental analysis. This strategy mainly relies on technical analysis, neglecting fundamental factors that can influence markets. Requires monitoring. Traders need to monitor price movements closely to identify potential entry and exit points accurately. Well, let's move to the next type, when trading with volume indicators. Volume indicators are tools used by traders to gauge the strength of price movements and potential reversals. Combining range trading strategies with volume indicators can provide valuable insights into market conditions and improve decision making. But first, you should know the basics of how to utilize volume indicators. Volume indicators such as the one balance volume or OBV, volume weighted average price or VWAP, and accumulation or distribution or AD line measure the strength and intensity of price movements based on trading volume. These indicators help traders assess whether price movements are supported by a significant number of traders. Let's get to practice. So, this is the practical explanation of this range trading strategy using volume indicators. First, confirming range breakouts. One effective use of volume indicator is to validate breakouts from a range. When the price breaks above resistance with a surge of volume, it suggests a potential bullish breakout. Conversely, if the price breaks below support with increased volume, it indicates a possible bearish breakout. Volume divergence. Volume divergence occurs when the price makes higher high or lower low, but the corresponding volume is decreasing. This could signify weakening momentum and the potential for a reversal back into the range. Are you wondering about the pros and cons in range trading with volume indicators? Let's talk about it. The pros. Confirmation of breakouts. Volume indicators provide a tangible way to confirm the strength of range breakouts, enhancing the accuracy of trading decisions. Early reversal signals. Volume divergence can offer early warnings of potential reversals, helping traders exit position before significant losses occur. Objective decision making. Incorporating volume data adds objectively to trading decisions, reducing the influence and emotional biases. Now, talk about the cons. False signals. Like any technical tool, volume indicators can generate false signals, leading to losses if not used in conjunction with other indicators and analysis. Complexity. Learning to interpret volume indicators effectively requires time and practice, making it more complex for novice traders. Market conditions. Volume can be inconsistent in certain market conditions, leading to unreliable signals. Okay, let's move to the last type of range trading. Range trading with volatility indicators. Range trading strategies with volatility indicators are a popular approach in forex trading. These strategies are based on the idea of identifying periods of relatively low price movement, and then using volatility indicators to anticipate potential breakout or reversal points. This method is particularly useful when markets lack a clear trend and exhibit sideways movement. Volatility indicators. Volatility indicators measure the degree of price fluctuation within a given period. They help traders identify when the market is likely to experience increased or decreased price movements. Two common volatility indicators are average rate or ATR and the Bollinger Bands. Now let's talk about the ATR. ATR measures the average range between high and low prices over a specific number of periods. Higher ATR values suggest greater volatility, while lower values indicate reduced volatility. Traders can use ATR to set stop loss and check profit levels based on the current market volatility. Now, Bollinger Bands. Bollinger Bands consist of moving average, typically 20 periods, along with upper and lower bands that are calculated based on standard deviation of price from the moving average. In the ranging market, price tend to stay with the bands. Breakouts occur when price moves beyond the bands. Okay, I think that's enough for the basic volatility indicators for range trading. Now let me explain to you practically. Using volatility indicators in range trading. Range trading strategies with volatility indicators involve the following steps. Step 1. Identify a range. Use support and resistance levels to define the upper and lower boundaries of the price range. Apply volatility indicators. Apply the selected volatility indicator or ATR or Bollinger Band to the chart. This helps to gauge the current market volatility. Step 3. Identify potential trades. 1. Plan a support. When the price approaches the lower boundaries and the volatility indicator suggests lower volatility, it could indicate a potential buying opportunity. 2. Sell the resistance. When the price approaches the upper boundaries and the volatility indicator indicates lower volatility, it could suggest a potential selling opportunity. Now step 4. Set stop loss and take profit level. Use the volatility indicator to determine appropriate stop loss and take profit levels. Larger ATR value might require by stop loss levels, while smaller values could allow for tighter stops. Okay, that's the practical explanation of range trading using volatility indicators. Now, how about the pros and cons? The pros: suitable for ranging markets. Range trading strategies are effective when markets lack a clear trend and exhibit sideways movement. Defined risk. Volatility indicators have trailed service risk level through stop loss orders, contributing to better risk management. Third, clear entry and exit point. The strategy provides clear entry and exit point based on support, resistance, and volatility indicators. Now, the cons. First is false breakouts. Breakout signals based on volatility indicators might lead to false signals if the market changes its behavior suddenly. 2. Limited profit potential. In the ranging market, profit might be limited compared to trending markets where significant price movement occur. Third, market shifts. Ranging market can transition into trending market unexpectedly, leading to potential losses for range trading strategies. After we know all the pros and cons of each type of ranging trading strategy, let me wrap up or give more explanation about the risk and the limitation of range trading strategy in general. 6 risks of range trading strategies. First is false breakouts and the choppy markets, limited profit potential, market shifts, and time consuming. 5 limitations of range trading strategies. First is market conditions. Range trading is most effective in stable sideways markets. In trading markets, range trading strategies can be less effective and result in missed opportunities. 2. Risk-reward ratio. Since range trading often involves smaller price movements, the risk-reward ratio of trades can be skewed. Traders may need to risk a large amount to achieve a smaller profit, which can impact overall profitability. 3. Transaction costs. Frequent trading within a range-bound market can lead to increased transaction costs due to spreads and commissions. This can eat into potential profits, especially when gains are relatively small. 4. Lack of trading opportunities. Range trading strategies focus on capturing price movement within a range, which means traders might miss out on significant profit opportunities during trending market phases. 5th, psychological challenge. Range trading requires discipline and patience, as traders need to wait for optimal entry and exit points. The repetitive nature of this strategy can also lead to psychological fatigue and emotional stress. Alright, I think that's enough for the range trading strategies discussion today. You have to know the basic of range trading, the range trading type, and the risk and the limitations. Hopefully, it can maximize your insights about trading strategies. I hope I can see you again in the next video. Bye bye.